Hi, I'm Jeff Turnahoy, Lipper's Head of Americas Research, and I'm joined today by Senior Portfolio Managers at SEI, Roy Borzellino and Scott Gyers. Welcome, gentlemen.
Thanks, Jeff.
Thank you.
Roy, the first question is for you. Your fund has now won 3 consecutive awards for the 10-year performance period. What's the secret of this fund's success?
Well, it really is no secret other than being disciplined and being long-term investors. What we do at SEI is we're manager of managers, which means we go out and we hire professional money managers to run investment strategies on behalf of our fund. Now, we do a lot of research in terms of understanding their skill set, how they find good ideas, and how they get good ideas into their portfolio. So we're always looking for a good manager with defined skill sets that have some persistence to it. The other thing we do is we combine various styles together in a fund for risk management reasons. By combining these styles, you minimize a lot of risk, and you get to focus on the risks that are, again, more persistent and the ones that actually reward you longer term. So the fact that we've ranked so well in the Lipper ranking is because we have very good managers that provide the return part of the equation, and then we focus on the risk side. So combined, we're always aiming for the highest risk-adjusted returns possible, and that's effectively how we do it, focusing on the long term, and don't be dissuaded by short-term volatility in the market, because returns really aren't earned quarter by quarter. They're earned over a longer period of time, usually 3 to 4 years.
Right, that's right. Now, Scott, your fund has now won the 1-year, 3-year, and 5-year risk-adjusted return in its category this year. Can you tell us about its strategy?
Sure, absolutely. Well, first of all, I'd like to say that we are very pleased to be the winners of the Lipper Award for risk-adjusted returns for this fund, certainly not just over the short term, but over the longer 3- and 5-year categories. And we really think that the Lipper Award is a testament to the success of our investment portfolios and our strategies, and the way that we construct those portfolios in a manner that's very risk controlled. Now, as Roy mentioned, the key to our success, I think, is how we combine various manager skills in a way that not just generates excess returns for us, but in the way that we minimize the amount of risk we have to take in order to achieve that level of success. And this is a level of success, I think, that really differentiates us from a lot of the competition in trying to find that balance and hit that sweet spot in generating returns in a very risk-adjusted way.
Now, next question is for you, Roy. These funds are important to SEI's process. Can you describe what that is?
Well, the process itself really relies on asset allocation. We're big believers in asset allocation and what that does for client portfolios, being able to diversify portfolios, being able to provide you returns that you may not see in the local market. So all those are important. Now, many Canadians, though, have a home country bias, meaning they love Canadian stocks. So they tend to have a lot of Canadian equity exposure, maybe too much. And that goes for bonds as well. They tend to have a lot of Canadian bond exposure.
That's right.
What we suggest is that you should have a lot more exposure to other asset classes as well. We've been working with institutional clients for 15 years in Canada. We've been working with retail investors as well. They're best served when they have broadly diversified solutions and portfolios. One of the things that we're going to be introducing soon in Canada is goals-based investing. And we've been doing this effectively for 10 years in the US with our US client base there. And what the interesting thing about goals-based investing is that goals-based effectively looks at drawdown risk, whereas normal portfolios are built out of mean variance space, so they look at standard deviation.
Right.
But drawdown risk is very different. And I think in this environment, this is where clients are extra sensitive to preserving capital. So we think these solutions are going to be very effective.
Now, speaking of extra sensitive clients, a lot of conservative strategies outperform in 2011. Scott, do you think those same strategies will outperform in 2012?
Well, we do think that there's a high probability of that event reoccurring. And the real reason for that really is because of volatility. And as we've seen, certainly in 2011, a lot of the volatility that we've experienced there was somewhat similar to what people have experienced back in 2007 and 2008. And whether you talk to a professional seasoned investment money manager or talk to an individual customer, you're kind of getting the same gut feeling in terms of how that ride has been. So this is really the key to our success at SEI and how we try to counterbalance that volatility and really smooth that ride for the customer. We're trying to strike a balance between achieving a high enough level of return, but also allowing customers to sleep well at night. I mean, this is really where our goal-based strategies that are coming into play in 2012 are going to really help us, because we have a variety in terms of the spectrum of risk and reward that we can offer to clients in things like some of our conservative strategies are very tailored to that downside risk. So someone who has a low tolerance for that volatility can clearly be well served by trying to match that investment solution to the goal that they're trying to achieve with their investments.
Okay. Now, Roy, final question for you. What do you think will be the drivers of success in your portfolio this year?
Well, we're very optimistic about equity returns in 2012. I think coming into 2012, we saw a very nice lift in January, and that was really being driven by investors coming back into the market. So we think that Canadian equities are undervalued. We think that bonds are overvalued, and possibly bond pricing has gotten to an extreme here. So we think once investors get comfortable again with assuming a higher level of risk, we think that the longer-term valuation story will play out and that valuations will move higher, and that'll be the key catalyst for strong equity returns. Now, on the other side is we still think that the corporate profitability story is still very buoyant. And there's going to be some good profits generated this year out of gold companies and specifically out of energy companies. And that energy stocks is somewhere where we have an overweight too. Our managers are very bullish and very constructive on energy stocks right now. They like the heavy oil, the light oil plays in Western Canada. And we think that in combination with good oil pricing and higher production profiles, corporate profits are going to be very strong this year in 2012.
Okay. And final question, Scott. What do you think will be the drivers of performance in your portfolio?
Well, certainly volatility has been a key driver of returns in fixed income markets in 2011. And in 2012, we think that that could continue. All you need to do really is look at what's happening outside of Canada. And you'll notice that even the Canadian fixed income markets aren't necessarily influenced by what's happening locally, but more so by what's happening on a global scale. So all you need to do is look at the Greek debt situation and the troubles they're experiencing there, and even south of the border in terms of the political situation and what policies might come out of a potential new leader there in the United States. So there's a lot of volatility being infused into the market right now. So this is why, to us, it's critically important to really understand the value of that asset allocation decision and to help our customers choose an appropriate asset allocation for them that's going to deliver the highest possible return for them for a certain amount of risk. And that's where that risk-adjusted return metric is very important to us. So we think that by focusing in on providing the most efficient returns possible for our clients, we're really going to be doing the right things right, not just for our investment solution, but for all of our clients.
Very good. All right, thank you, Roy. Thank you, Scott.
Thank you.
Thank you.
On behalf of SEI Investments and Lipper, I'm Jeff Turnahoy. Thanks for watching.